Now, would you believe a staggering £26 billion of pension money is actually left unclaimed or lost in pots, according to the Pension Policy Institute?
Well, actually, Rishi Sunak could use a lot
Dip
of that.
into that, couldn't he?
Handy. Well, how do we track and consolidate our pensions? Let's talk to Tom Selby, Head of Retirement Policy at AJ Bell. Good to see you this morning.
Morning.
Right, now it's terrifying that there's 26 billion quid out there, which is unclaimed, sitting in pension pots. How can this happen, and what can we do to make sure it's not our money?
So the first thing to say is that £26 billion is money where the pension provider that's looking after the cash has lost track with the person whose money it is. So that can happen for a number of reasons. It's usually if you move house, so you lose track, the pension provider might lose track of someone's address and details, so they don't know where they are, or if you switch jobs as well. So people nowadays tend to switch jobs quite often. It can be that's kind of once every year, once every couple of years, particularly for young people as well. And so what you end up with is lots of different pension pots building up with lots of different providers. Everybody loses track of them, and people potentially aren't making the most out of their retirement pots as a result.
Right, so how do you consolidate that?
How do you consolidate? So, the phrase, the buzzword.
Yeah, so it's not as easy as you would like it to be sometimes. So one of the challenges is that you need to get your old employer scheme's details in order to move your pensions to a single providers. So to do that at the moment, you use what's called the pension tracing service. So as long as you've got your old employer's details, stick those into the pension tracing service. That'll give you scheme details. Then
is that free?
That's free.
Right,
that's
free. Sort of government-funded scheme.
That's a government-backed scheme. Now, there are reforms coming down the track that will mean that you can see all of your pensions in one place online, and then you'll be able to consolidate a lot easier. Now, that's going to take a few years. It's going to be called Pensions Dashboards. I think it'll be a good innovation for pensions. It'll help people connect with their pensions a lot more easily. But it's just taking a few years to come.
So what do we make of these? There are various apps out there and platforms that claim they will consolidate all your pensions for you. What's the catch there, then? Are they charging you a fee for doing so?
So any platform that's offering a service like that will be charging you a fee. They'll also obviously want to administer your money as well. So if you're thinking about moving all your pensions into one place, one of the key things that you need to consider is the amount that you're paying in costs and charges. So it can quite often seem like small differences. So one provider might charge, say, 0.75%, and one provider might charge 0.5%. But when you scale that over 20, 30 years, it can end up being tens of thousands of pounds extra cash in retirement. So there are different providers that offer you different kinds of services, but there will be costs attached to that. So it's just making sure you get the right one for you.
And you mentioned, obviously, nowadays, people change jobs and employers all the time, and it is famously youngsters who take less interest in their pensions than other people. So if there are youngsters watching this who've moved, do you think is there a time limit on how long it can take till you can claim any money you might have lost track of in previous jobs? Or could you be 65 and thinking, I remember I worked for, I don't know, the BBC or the NHS for 15 years when I was in my 20s?
Yeah. So there's no need for anyone to worry about that. So the money is yours. It's your pot of money. It might be sitting with an insurance company that you've worked for 20 years ago, but it's still there. And as long as you can get the details of that money, then you'll be able to get it back. As I mentioned, pensions dashboards are going to make that all a lot easier for people. So even if you've got a really old pension from way back when, you'll be able to see that and combine it with something else. So all of that process is going to get a whole lot
why
easier.
bother then combining it? Because presumably, as long as if you can track them down and update your details, they'll pay you out your pension. You'll just get lots of small checks, as it were, rather than a big one. Right?
Yeah. So the main.
So what's the benefit to having it all in one pension pot?
So one of the main reasons that people generally do it is because it's easier. So if you had 5 different bank accounts with 5 different banks, then that might be quite a complicated set of things to keep track of. So having them all in one place is easier. And as I said, you can benefit quite significantly from reduced costs and charges. So particularly when you're looking at older style pensions, sometimes they'll have charged 1.5% or something like that. So in modern pensions, you shouldn't be paying any more than 0.5%, certainly no more than 0.75%. And when you look at that difference in charges on a decent-sized pot of money, if you're talking about £100,000 plus over the course of someone's lifetime, that's going to be a serious chunk of cash. And given where we are at the moment, I think most people would want to save as much money as they possibly can.
I do think it's quite scary when you look at pensions and you get your pension prediction, what do they call it? The forecast.
Your projection, right?
Yeah. And you look at that and they turn around and say, well, this means if you carry on like this, you could be getting £13,000 a year or whatever. And you think, well, blooming heck.
Yeah.
That's not a lot of money. What sort of target should you be setting for, a sort of decent enough wage to survive on? What sort of pension pot size do we need to accrue?
So it's a difficult question
Depends
to
on your
answer
spending.
because it depends on your
yes.
life. So an organisation called the PLSA came up with what's called the retirement living standards, and the idea behind that is to give people a rough idea of how much different standards of living will cost in retirement. So if you want a very basic standard of living, they reckon it's just over 10 grand for a single person. If you want a moderate standard of living, they're talking about kind of 20 grand, and if you want a comfortable standard of living, so lots of holidays, lots of luxury and things like that, you're talking about just over £30,000.
£30,000 in today's money.
In today's money per year. So in terms of the size of pension pot that you'd need for those different amounts, you'd be told, I mean, if you're looking at a healthy 65-year-old to have that comfortable standard of living, you're probably going to be looking north of £600,000-700,000, something like that, in a pension pot. Now
That shocked you, hasn't it?
I'm not retiring anytime soon.
That is going to sound terrifying for a lot of people. There's two things to think about there. Firstly, you've got your state pension on top of that. So the state pension provides just over £10,000 a year of guaranteed income. So you've just got the extra £20,000 to make up. And it's if you're looking to save up a decent amount of money, and we're talking about the top end there, then it's about saving regular and often. So something like £500,000-600,000 can sound like a huge amount of money, but actually, if you make sure you're topping up your pension by as much as you can afford, very difficult for people at the moment. But even if you can add an extra £50, £75 per month to it, over the course of your lifetime, that money can grow, and you can end up getting a decent amount in retirement.
Good advice, Tom Selby. Head of Retirement Policy at AJ Bell. Thank you, as always. Lovely to see you.
Thank you.
600-700 grand. Well, bear in mind, that's not just your own money, though, is it? That's money that your employer will put it. And am I right in thinking that total there, what you're using in that total is how it's gaining on the market as well? So you don't actually have to. That's not the amount of money you have to put in.
No. So you would gain some from the market as well.
Yeah.
You get tax relief from the government as well, and as you say, you'll get your matched employer contribution.
You might get tax relief from the government. We shall see on Thursday.
Not quite.
That might all change.
Yeah.
Lovely, Tom. Thanks
Thank
very much
you.
indeed.